Hey guys, it's Jay here with another video for you. Today I'm going to be having a look at Forex. Okay, we're going to be having a look at the London breakout strategy and also a triple EMA strategy that you can use for scalping. Okay, so first up, the London breakout strategy. Why do they call it the London breakout strategy? Well, the reason is that we use the strategy to enter trades at the beginning of the London trading session, and we look to catch a breakout while the session is in play. Okay, so looking at the screen in front of you here, nice and simple, you've got the hourly charts, you've got regular candles. I'm on the British pound US dollar currency pair over there, and that's going to be the basis for setting up your trades. Okay, now the question is, well, when would the London trading session start for you? It depends where you are in the world. Well, if very easily, you can actually go onto your indicators and search for sessions, and then you'll see here sessions on chart. So you just click on that, and then you can see you've got these three bars that have appeared. The green bar is the London session. So here in South Africa at 10 o'clock in the morning, the London session begins, and that London session runs through all the green, all the brown, up until 6 o'clock in the evening here in South African time. The red bar that you see there is the New York session, okay? And the New York session actually starts over here, because the brown session that you see there, that is the overlap between the London session and then the New York session. Okay, but what we're going to be focusing on today is the London session. Now, by using this sessions indicator, no matter where you are in the world, so long as you have set trading view to your local time, the sessions will show you where the London session is going to start for you. Okay, so the idea behind the London session is that when the market opens, okay, you very often see a flood of activity. Either you can go long, or an opportunity will be to go short. The reason why this works is that as soon as the markets open each day, you've got the world's biggest market, trading market, which is the London session. A lot of money coming in, a lot of money going out, and you get a lot of movement, a lot of big movement quite often. Okay, so the idea then is we want to try and catch when this session starts. Okay, now this was yesterday's session, and that would have been on the 27th of December 2019. As you can see, when London opened here, we had a lot of movement, and you see the price went all the way up there. Just check my lacquer squiggly line there. This particular move, if we want to just check and see, could have got you in the region. What's going on here? Okay, there we go. Could have got you in the region of, yeah, you're looking at 60, well, about 70 odd pips, thereabouts. Maybe a little bit more if you just take into this section over there. You could have got maybe about 80 pips out of that. So now, how do we actually jump on that, and how do we get that? What we want to do then is, on the hourly chart, you want to have a look at the hourly candles, the previous three candles to when the London session opens, which would be this candle, and this candle. Okay, now what you want to do then is you want to take a drawing tool. Okay, you can either use a trend line. What I like to do sometimes is I like to use a rectangle. Okay, and you draw a rectangle around those three candles. And what you want to do is let's do it like that. Okay, and expand the box across. Okay, and what you want to do is you want to just check to see the highs and the lows, and you want to place the top of the box a few pips above the high, and then you want to place the bottom of your box a few pips below. Okay, now that is what I call the zone. All right, now we're waiting to see if the price will break up out of that zone and go in the direction that we want. So if I just do this, let me close that. As you see, as the time progresses, the candles appear, candles appear, candles appear. Okay, now this is how you would set your box up just before the session opens. You should look something like that. Okay, then the London session opens, and then you need to set your trades in order to catch this move up. So when setting the trades, we literally set it a couple of minutes before the London session opens. Okay, now what you would do then is, according to your box, okay, you would set a buy stop at the top of your box over there. So let's see, trend line. So you would set a buy stop over there, okay, and at the same time you would set a sell stop over there at this price over there, and a buy stop at that price there. The idea being that when the price moves out of that box, your order will trigger, and then you will catch the remainder of the move as it moves up and away. Conversely, the same works for shorts. If you have a box like this, okay, then London market opens and the price can actually also go down. And what will happen is this sell stop here will trigger, and then you're in the trade to catch the movement if it is going to be going down. Okay, now something to bear in mind is if your buy stop triggers, then you cancel your sell stop. And then if your sell stop triggers, you cancel your buy stop. You want to have just one trade running in either direction. Okay, you don't want to leave the two in. Sometimes the price can whipsaw a little bit inside here for a little bit, and it might actually come down and trigger there, and then go up and trigger there, and then break out. And if that happens, you're going to have two trades running, which is not ideal. The idea is to catch the main move, get your pips, and then look to exit the trade. Okay. Now, exiting the trade is entirely up to you. You can decide when you want to exit. Okay. You can wait and wait and wait until it gets up to this area over here, and then you can exit. Or if you say, listen, I'm happy with 50 pips or 30 pips, set a sell order to exit the trade, and then take your pips. Okay. What you could have done here is you could have entered there, and then at the top of this candle thought, okay, cool, that's already 27, 28 pips. I'm happy with that. Close your trade. Because what you see afterwards is you see the price comes back down again. Okay. Now, remember, the price does not always continue straight up from here all the way up. Sometimes it comes up, it exits, and it starts to come back down again. So you do need to keep an eye on it, and you do need to take profit at a time that you're comfortable with. But just be careful, because the price can actually return back down and can also start going in the opposite direction. In terms of stop losses, okay, the general consensus is that you use this range of your box for your stop loss. So if you're in a long position, your stop loss will be down here, and if you're in a short position, your stop loss will be at the top over there. Okay, so looking at that, I was in this trade yesterday, and I pulled out 200%, and then I pulled out another 125%, and I think another 100%. So I did get, well, over 400 percentage points out of this move. I didn't stay in the whole trade all the way. I kind of like to take my profits at a certain point and then look to see if there's a pullback, and then look to enter again if the price is still going to go up. Okay. You can see on the previous day, that was here. Obviously, we've got a short gap here because this was Christmas Day, I believe, and then this was Boxing Day. So you don't have a wide session over there. It was only a small session that was there. If you had done it here, you would have drawn your box like so. Okay, and then swung it across. And looking at that, it would have been a very quiet day. Okay, your trade wouldn't have triggered at all because the price just floated in and out. And when you get to this sort of point and the price hasn't triggered, then you just cancel your trade and say, okay, great, I'll wait until tomorrow. Okay, it doesn't always work out that you get into a trade every single day. Okay, but when you do, it can prove to be quite profitable. All right. So that basically is how the London breakout strategy happens. You do it once a day. You can set your trades, your sells, and your buys, and wait to see which way the market goes. and then ride it and take your profit as you go along the ride on the way up. The best pairs to use for this particular strategy tend to be the British pound pairs. So your pairs like British pound, Aussie dollar, Canadian dollar, Japanese yen, USD. Those tend to be the better ones because you are dealing with the London markets. So obviously the pound is the UK currency. But, some of the guys in the Discord, we have noticed that other pairs do also react when London opens. So don't just stick to one particular pair. Then, look at British pound USD always, but also have a look at a couple of other pairs and see if there was any particular action. Let me just pick one here. Euro AUD. Okay. So here we've got the Euro AUD. We would have set our box around about there. Okay. Now the distance between the high and the top of your box, you should probably make it maybe 4 pips, maybe 5 pips. Okay. This is actually a good example of what can go wrong. If you make your box too small, all right, what happened in this particular example here? Let me just zoom in a little bit so you can see. You set your long position there, and you set your short position down here. So what happened was when the market opened, the price shot up out the box. And what that would have done is that would have triggered your long position, okay? But price then immediately came back down and carried on going down and down. And at this point, you would have been stopped out and you would have lost out on that. So you do need to be aware that the strategy is not always going to work 100%. Okay, you are going to have days like this particular example here where the price is whipsawing up and down and up and down. If you did set your entry points a little bit further away, then you wouldn't have triggered there. The price would have come down, all right, and it would have triggered here. And then if you had set an initial exit point of, say, 10 pips, you probably would have made 10 pips out of that move over there. Okay, but this is just an example to show you that it doesn't always work. You must be aware that the price can go up and down quite a bit before actually breaking out. And you can see there was another breakout to the top here, and that was when London closed and New York continued. Okay, just something to be aware of there. Moving along, here's another nice example for you. Okay, draw your box around the 3 candles before, extend it out a little bit so you can see. All right, make it a little bit more there. Okay, so that's more or less what it's going to look like, your box. And what happened was London opened, price went down, it broke the zone. Okay, it triggered your sell, so you would have cancelled your long position, and then that went down over you would have got about 30 pips, maybe 33 pips out of that. And if you were using PrimeXBT, then you could have been looking at getting a 200% move there in the space of 3 hours, 4 hours. Okay, so that, guys, is the basis of this particular strategy. You can feel free to contact me if you've got any more questions on it. This is what myself and a few of the other guys on the SMB Discord do on a daily basis. We look for these breakouts. We try and catch these breakouts. Okay, so yeah, that's that particular strategy. Any questions, get hold of me. I'm now going to just quickly tell you about a 3 EMA strategy that you can use, that if you happen to miss the breakout and you can see the price is trending in a particular direction, then you can use this 3 EMA strategy in order to enter and hopefully catch some more pips. All right, time to have a look at the 3 EMA strategy now. So here is the London breakout that I've just told you about. Okay, we're still on the British pound USD now. We will be changing the charts from 1 hour to a different time frame. But what we want to do here is we can now remove the sessions indicator because you already are in the market. So let's take that off. Okay, I'll leave the box there for now, just as reference to see where the breakout was. Now, the 3 EMA strategy, it's a very simple strategy. You use it to find good entries into a trending market, okay, in order to try and jump onto a trend and to get some profit out of that. So for an example here, you can see the price here broke out of the zone, okay, and say you took your profit over here, okay, you exited your trade and you pulled out, yeah, you might pull out about 100% if you're on a PrimeXBT. And then you think, crumbs, it might still be going on. I want to be able to get access into this. I want to enter again. So what we want to do now is we want to put on a triple EMA onto your charts. No, not that one. That one. Okay. So here, if you go onto Trading View, you can search for 3 EMA. Okay. And you can click on that, and it's going to put 3 EMAs onto your chart for you. Now we need to change that. We're not going to use the stock settings of 50, 100, and 200. So let's go into the settings, go into inputs. The first EMA we're going to make it at 8. Second EMA we're going to make it 13, and the third EMA we're going to make that 21. And what I like to do is I like to use it like a traffic light. So green would be the shortest EMA, orange would be the medium, and then red would be the longest EMA. So the chart's looking like that at the moment. Okay. Now what we're looking for here is we want to just check quickly before we change the time frame. We want to check quickly that the EMAs are busy in an upward side, pointing upwards, and they're all spreading out quite nicely. Okay, and we can see here on the 1 hour chart that's exactly what's happened. We've had our breakout, we've taken our profit, we check, okay, the EMAs are busy fanning out quite nicely because you're going to look to enter around about here. So looking down there, you can see the EMAs are upward and they are spread out very nicely. So what we're going to do now is we then go to the 5-minute chart. Okay, let me move across now. All right, so what you can see here, right, is our zone box, okay, that we were in. We came out and we rode this up, and we probably took profit around about here, okay. And then you saw the price pulled back a bit, and you thought to yourself, okay, I might want to try and re-enter here. So you're looking at it and seeing, yeah, you're seeing a lot of pullbacks coming along here. Let me just check on something. Okay, so from the breakout, sorry, I'm down on the 5-minute chart. I just got confused with how wide and how long the times were there. So on the breakout, we entered about here, okay, and then the price went up and we exited more or less about there. Okay, price then pulled back a little bit, and we thought to ourselves, how we'd like to actually get back into this trade in order to try and get some more profit out of it. So what we do is we look at the 8 EMA and the 13 EMA and the 21 EMA. Okay, are they moving in an upward direction? Yes, they are. So what we do is we wait for a pullback that comes in and cuts into these EMAs. All right, so looking here, you can see the price went up. We had a pullback, and the price here touched this green EMA, which is the 8 EMA, and then the price started to go back up again. So this is what we would call a trigger bar. Okay, and what we want to do then is once a candle touches the 8 EMA, it can also touch the 13 EMA as well, but once it touches that, we want to count back 5 candles, okay, and look for the highest point in those 5 candles. So 1, 2, 3, 4, 5. So out of those 5 candles there, this candle here is the highest. So there. All right, that is going to become your entry point. So what you want to do then is you want to set a stop buy, okay, at that particular price. So in this case, it was 130760. All right, and then you want to set your stop loss just below your trigger bar, which is there. So your entry price would be there and your stop loss would be there. The idea being that as the price progresses and moves on, you're going to be waiting for the trend to continue up to a point that it triggers your buy order. So we're still waiting, we're still waiting, we're still waiting. And then over here, we see here, we entered the trade right about there. Okay. Then price went up and up. Let's just extend this across. There we go. Price continued up, and then we had an opportunity to take more profit out there. Now what you can do is once the price breaks through and it moves up, you can take your stop loss and you can move it to your break-even point over there. Okay, and then let the price continue up, and then at some point you must decide when you want to take your profit out, because as much as the price goes up, we'd all know that it does come back down again. So if we had carried on going, okay, it actually could have been a very nice add-on to our particular trade up to there. Yeah, you could have got almost another 300% if you were in prime, another 38-40 pips out of that particular move. Now the idea of placing your entry above the previous high of the trigger candle is that you want to make sure that the price is going to be breaking out again and moving above that and continuing up. If you had entered if the price had come down here, okay, and you entered right about there, the price could easily have continued to go back down again. Okay, so you have that little bit of a window. Sure, you're going to lose some pips, but you'll have a better chance of the price continuing in your favor if it actually breaks out of this particular zone. Because you can see here, we actually were trading in a range here. Price came up, stalled, came down, up, down, up, down, up, down, and then it broke through, and then it carried on the way up. Now you can do the opposite of the strategy for sell orders for shorts. Okay, it's just something that will help you. You know, if you enter into a breakout like we did here, we took the profit there in the space of 15 minutes, and we thought, okay, if it carries on, I want to enter again. This is the strategy that you can use to enter again. Okay, the 3 EMA strategy. I'll say it again. It's the 8 EMA, 13 EMA, and the 21 EMA. As you can see here as well, the price did bubble up and down a little bit more. So when it came here, it exited the EMAs, came back down. You had another trigger bar, so you could have done the same process there. Put your buy order in, put your stop loss in, and then waited. You know, and you can update it as the price moves along, or you can just stick to your original point and then just wait and see if the price does break out. If the price does not break out and goes the opposite direction, then you haven't entered the trade, you don't lose. Okay, you know, when it comes to trading, a trade that doesn't happen is actually a winning trade in a sense, because you haven't actually lost anything. All right, so that's just a simple entry strategy for you guys if you want to use it. That's what I do use. If I do have a breakout, I take profit, and the price continues to move in my direction, then I will wait for one of these pullbacks to occur, and then I'll set my new 3 EMA entry strategy to see if I can maybe catch a bit more profit from that move. Okay. All right. So then, yeah, that's that. If you've got any questions, then again, you're more than welcome to contact me. As you know, I'm always happy to help. And good luck with it. All right. Take care. Cheers.